When you look at an organization, at a company in general, sometimes many people have a very superficial view of that company by looking at a single aspect. That's why in this session we're going to cover what's called financial structure to understand what are the key components that make up a company from a financial standpoint that go behind just like revenues or profits or cash. We're going to look at those three aspects. So when we look at a financial structure of a company, we want to look at three main things. First of all, of course, we want to look at things like profitability, so how revenue on one side and expenses on the other side make up profits for the company. Let's remember that having a company that grows in terms of revenues does not mean that actually is also generating profits. It might be that actually the company is losing money. And why is the case? Because we want to look at the cost structure. So how is the company organized around fixed and variable costs so that as it grows, it can generate profits out of the existing business? So this is extremely important because when the cost structure is aligned to the revenues and the growth of revenues of the company, then that's when you have a profitable company over time. And as you look at the profitability, you also want to look at cash flow generation, because one thing is profits, another thing is cash. And this might sound trivial for some others, may not, because remember, there are many companies that go out of business not because they are not profitable, it may be they are, but because they lack cash. So they lack short-term liquidity, which leads them to go to bankruptcy. So how do you avoid that? Well, you need to balance those two things. So you need to understand how the cost structure of the company is organized around fixed and variable cost, and how those help you actually reach profitability. But also when you are profitable, you want to understand whether the company is generating enough cash flows in the short term. So imagine the case of a company like, for instance, like Netflix, that is profitable in the short term, but it might be cash flow negative. Why? Because the company is anticipating the money to produce new content on top of its subscription platform, and is getting paid by users over time on top of its own platform, so to pay back this content. So if I'm Netflix and I'm investing, let's say, $100 million in content generation today, this $100 million is going to be paid is going to make already the company profitable, for instance, in a short time. But for me to pay that investment is going to take me, a longer time, and the cash that is going to get in for me to repay the content investment is going to take more time. So again, it's very important that when we look at financial structure, we look at three elements. So we look, yes, at revenues, but also how the cost structure is organized as the revenues grow, so that we can reach profitability. And also when profitability is reached, how we can actually make sure that we're generating enough cash to sustain our operations in the short term.